Hey folks, it's
let's
time
talk
to talk
depreciation
about
again,
depreciation.
units of output.
So we've got some new terminology in this class,
You're not going to like this
or
one
in
bit.
this lesson,
I
in this chapter.
have
So
always
let's talk
done
about
units of output a
definitions
little bit differently than
before we
what
get
the
into
way
the
the book
problems.
has done it.
Okay,
And
depreciation
works
is defined
better for me
as allocating
because I don't
the
have any
cost
kind of a
of a
rounding
long-term
issue
asset over its useful life.
So what I'm going to do is
So
I'm going
what
to
we're
go
doing
over
is we are
my
taking
method, which is this
assets like
We're going to
property,
also,
plant, and equipment,
as
which
we
would be
do
your
year,
buildings and your equipment.
we're going to do
and any
the
machinery
journal
you have,
entries,
and
the adjusting
maybe
entries
some
for it,
office furniture,
and
or
we're going to
office
post
equipment,
to the
whatever.
accumulated depreciation
And
T account.
we're going to use it over
And
several
we're going to
years.
follow it all
so
the
what
way
we
through
want to do
is we want to match
how it shows up
the
on our balance
cost
sheet at the end
of the asset, the
and
cost of using it,
everything all
with
ties
any
back
revenue
together.
it helps
So
us generate every
it works
year.
really nicely.
So we do that.
Okay, so
Jerry Link's
with the
formula
depreciation.
is,
So as we use
for
an
units of
asset each
output,
year,
which is
we
a
write off a
activity
little
type
bit of
method,
its
we're
cost
going to take our
each year
cost minus salvage
to the income
because we can't
statement, so that
depreciate
at
below
the end of the
salvage.
asset's life, most of
I'm
that
going to
cost has been written
multiply
off
by
as we've
the
used it. So
current
it's matched
period's
the expense
activity
with the revenue
so
it helps
this year's
generate.
activity.
That's the plan.
And
So
I'm going to
it's a
divide
cost
by the
allocation
total
method.
expected activity.
Depreciable
and that formula
cost
will give me
is the
depreciation
total.
expense.
Okay, let's go back to this one more time.
So let's
You remember
look at
when
the
we
activity.
talked about
So I just
adjusting
made up
entries
numbers.
and we did a
We've
prepaid
got this
expense
copier that we
and
paid
depreciation was an example
$110,000
of that prepaid expense.
It's got a $10,000
That's
salvage
exactly
value.
what we're doing here.
I
Is we are
found
buying an
numbers
asset
that would give
we're
me some
prepaying
even
for it,
rates,
and we're going to write
even
it off, use
depreciation
an adjusting
expenses,
entry
so
to
the
write
math is
off
not too complicated.
that asset a little bit at a time over its useful life.
Total copies
kind of like
expected
we buy
out of that
a 12-month
copier is going
insurance
to be
policy,
20,
and we write
million
off 1 month
copies.
of insurance expense
So when you're
every
putting
month
that number
for the
in your
year
calculator,
until it's gone.
really
Same
all
thing
you
with
have to do is
depreciation,
to take
except it's
the
100,000
instead
times
of just months.
6 divided by
Okay, that
20.
might work better.
You don't have
Right,
to
depreciable
put the
cost
last is the total
6
cost
zeros on everything
of a long-term
and that's going to
asset
save some
minus
mistakes, I bet.
the salvage value.
So it's important.
100,000
because
depreciable cost is the
20th
maximum
is going to give you
amount of the
30,000
cost that can be depreciated.
The accumulated depreciation
and
is
it will also
30,000.
equal the
Okay,
total
so let's
depreciation
prove it.
expense for the asset.
Our journal
so you've
entry
got some
at year
check figures
1
right there built
is
in to know if
debit
you've calculated
depreciation
your
expense,
depreciation
credit
correctly.
accumulated depreciation for the
Another
copier,
very important
the
term is book
30,000
value.
I'm going to take this,
which is the cost of the
30,000.
asset.
I'm going to
minus
credit it
any accumulated
at the end of year
depreciation
1
for the same
to
asset.
the accumulated depreciation.
It
T
may
account.
also be referred to as net book
Okay,
value.
so what we have at the end
So
of the
let me
year
skip down for just
is
a
we've
minute
got,
and go to the balance sheet
a
presentation.
book value of 80,
This piece is
which is
extremely
the cost of
important, and you
110
must understand
minus the
how it
accumulated
shows up
depreciation
on the balance
of 30.
sheet. So
So
that
what we're going to do is you're going
80,000
to take the S
is what's
you're going
gonna
to show
be
up
on the balance
on our
sheet
balance sheet
in a
at the
classified
end
balance sheet
of
you've
year
got current
1.
assets, and then
Okay.
maybe some
So
investments.
we've got our copier,
and then property, plant, and equipment.
is at 110.
So we're in that
The
property, plant, and
accumulated is
equipment
30. The net book
section
value
of the
is
classified
80.
balance sheet. So we're going to
I hope
put
I
the
said that
asset
right a
on
minute
at
ago.
cost, and
The
we'll label
80,000
the asset
is
whether
what
it's
shows
building,
up on the balance sheet at
machine,
the end of year
vehicles, equipment, whatever
Okay.
it happens to be. And we're
Year
going to make
2.
sure we label it that this is the
100,000
what it costs
times
us.
5.
We
over
also
20
have to put on the
equals
face of the
25.
income of the balance sheet
Now,
the accumulated depreciation
for
is the
each
sum
asset.
of the 30 and the 25,
And then we subtract
gonna be
them,
55.
and the difference is our asset at
Oh,
its book
geez,
value
this makes it
or
go too
net
far.
book value. They mean the same thing.
Sorry, guys.
So FASB, which is our rule-making authority, tells
Okay,
us the
so
cost of the
accumulated
asset has to be
depreciation
on the
is
face of the
55.
statement, balance
My
sheet,
book value
along with
is
the accumulated
cost
depreciation
of 110,
and
minus
the net book
the
value
accumulated
then
of
is what
55.
is added
So the
into
book value is also
current assets
55.
and other assets
Journal
and
entry
debit
to come up with
depreciation
total
expense,
assets.
credit
So make sure
accumulated,
you understand where and
25
how
for
it
this
all
year.
shows up.
The
on
25
the
is
balance sheet.
posted for year 2 to
Okay,
accumulated
so salvage
depreciation.
value
And my balance is
depreciable
55,
cost, remember,
which
was
is
cost
my balance
minus salvage value.
Okay.
So
And
salvage
then we
value is
want,
the amount of money that a company thinks
the way it
it
shows
can
up on the balance
probably
sheet
sell
in year
that
2
fully used
is
asset
cost
for at the end of its
minus
useful life.
accumulated of 55.
It's not a
There's
whole
our
lot of
balance.
money.
but
equals
it might be,
book value.
you know, it depends on the asset, how much it is. Which is what another we had term for salvage value is residual value. In year 3, the final definition is accumulated depreciation of 100,000, and that is the total depreciation expense that's been taken on an asset since the beginning of its useful life. Be debit depreciation. Okay, so the journal entry that we make is going to be a debit to depreciation expense and a credit to accumulated depreciation. Is now 75. So what's happening is the depreciation expense goes to the income statement will become 35 account because I'm going to take the 110 at the asset's life minus the accumulated depreciation to give me the 35 is a permanent account on the balance sheet. 35 is what shows up about it balance sheet on the face of the balance sheet at the end of year 3. So that's a permanent account that never ever gets closed until you sell the asset. Value and then 35. When the asset's cost goes away, same song and dance that again accumulated depreciation will also go away. In year 4, so I'm going to take the 100,000 as cost minus salvage, as we're doing the other videos. 3 divided by 20 gives me 15,000. To show that what we're putting in accumulated depreciation simply accumulates every year to come up with a bigger and bigger balance. Is posted to my there's one more thing I didn't put in this little permanent account we're going to talk about closes in the other videos. So now my balance is 90,000. You cannot depreciate below salvage value. If I take 110 minus 90, I'm going to show a book value of 20, and then it'll be there, which will show up maybe I can my financial statements. All right, cannot 110 minus 90 depreciate. Is 20. Below one more time salvage value. Year 5, that's important. The 100,000 so cost you guys need to remember that. Times 2 over 20. Okay, 2 over 20 is 10%. So what I'm going to do is I'm going to take 3 depreciation methods that we're covering in this chapter. And I'm going to do a video over each one. Let's make the journal entry so that they're not too long and you don't have to lose your depreciation expense too fast. Credit accumulated so the 3 methods are going to be straight line, post the accumulated to double that T account. And our balance is now 100,000 for every example, which happens and I'll review it again for the end of the asset's life. We're going to pretend that a company purchases a new very fancy book value is the cost of $100,000 minus the 10. It's salvage value, so our book value at the end of the life, and it's going to last is 10,000 5 years going to show up on our balance sheet at the end of year 5 first. If we still have this copier on hand, did I? Because it is 20 okay, I hope copies. That shows you how that's all the pieces fit together. See you in a minute with straight line. So you're going to compute the depreciation expense. You're going to make the journal entry, post to the accumulated depreciation T account, and then show the financial statement or balance sheet presentation. And that's the whole process for depreciation, so that you see it from when we have the asset and decide how to depreciate it all the way to the balance sheet at the end of the year. Okay, items to notice are the same as they were for straight line. You want the total depreciation expense right here to equal the depreciable cost minus salvage. You want the total accumulated depreciation at the end of the asset's life right here to equal the total depreciation expense and the depreciable cost. And then you want the book value at the end of the asset's life to equal the salvage value because you cannot depreciate below salvage value. Okay, so that's my way of doing it. Let me show you how the book does it. Because when you're working the software, you're going to need to do probably what the book does, or else it's not going to give you the right answer. And then when it comes test time, you can work it whichever method you like. I don't care at all. It doesn't matter because you're going to come up, if you'll notice, with, in this particular case, the depreciation expense is going to be the very same numbers because I picked nice round numbers here. Okay, rounding is what's going to cause it to be different. Okay, so the way the book does it, they want you to do it in a 2-step process. And the first step is to determine the depreciable cost per unit. So you take the cost minus salvage, 100,000. You divide by the total activity, which is the 20 million copies. So that works out to a nice round half-cent per copy. Okay. Now, when you're doing the software in your book, there should be some red words that say round to 2 decimal places, 3 decimal places, the nearest whole number, whatever it tells you to do, that's what you do. And that rounding could very well make a difference in how your numbers come out and as to whether or not you have to spend 10 times getting the problem right. Okay, so in my case, I'm not going to round to show you that you come up with the same answer. And really, for this small a value, I probably wouldn't round it at all anyway, but the book might round it to a penny per copy. Okay? So step 2 is to determine the depreciation expense for the year. So all I'm going to do is multiply the depreciable cost, which is the 100,000, times the activity for the times the cost. Let's try again. Just start over on this line. To determine the depreciation expense for the year, I'm going to multiply the depreciable cost per unit, that half-cent, times the activity for the year. So, year 1, my activity, notice my activities are going to be the same for both systems. Okay, so 6 million times the 0.005 is going to give me $30,000. There's my formula right here. And I can double click. Oh, excuse me. I'm going to have to call her back. Sorry. The accumulated depreciation and book value work exactly the same as they did before. Year 2, 5 million times a half-cent is 25,000. Year 3, 4 million times a half-cent is 20,000. 3 million times a half-cent is 15,000. 2 million times a half-cent is 10. Again, the items to notice are the same. 100,000 total depreciation expense equals 100,000 total accumulated depreciation, and the book value has to be equal to the salvage value at the end of the asset's life. Okay, that takes care of this one. I'll see you in a minute for double declining balance. Stay tuned for more.